seeing specific PD arrays, and it's not just simply a fair value gap that fails. There's many times I want PD arrays to fail. Think about when I'm teaching you order flow, and I'm talking real order flow. Real institutional order flow has nothing to do with level 2 data. It has nothing to do with the DOM, depth of market. It has nothing to do with volume profile. It has nothing to do with any of that gimmick. It has nothing literally to do with that. It's literally how every candle supports price. As it's going higher, every down close candle. In that down close candle, algorithmic buying is taking place. So it goes without saying, when it goes above that and it comes back down and touches it, it's not going to need to go back down in there because the algorithm has already extended the opportunity for the algorithms that use this in a marriage, like a handshaking between the delivery mechanism, the price engines that cause the fluctuations in price, and then the algorithms that can handshake with it, like my enigma, that my conceptual idea of how to handshake with the market's algorithm. They dovetail perfectly together. That's what makes my stuff precise. That's what gives me the confidence to share things on Twitter before it happens, and you watch it happen in your chart every single week. For years now, 2 years you've watched it. Where my private mentorship, they've watched it for years. Years, daily, every single day. This is what I think is going to happen. And over time, you get comfortable with it. But when we see down close candles supporting price, what are we looking forward to on the opposite spectrum? When we're bullish on price, we want to see down close candles support price because they're acting as what? Bullish order blocks. But we want to see bullish candles on the other side, on the left side, that would be considered what? Bearish order blocks. As price was going lower, every up close candle should have offered what? Downside delivery, sell side delivery, moving lower. So we want to see price going through with ease up through them. That's real institutional order flow. There's no depth of market necessary. There's no fake ladders and spoofing that can occur in that. It's finite. It's in your chart. You can see it. Everybody has the highest high and the lowest low of every one of these candlesticks. Everybody that's looking at the NASDAQ futures contract, the same delivery contract month of December 2023, we all have the same high and low on that candle right there. There's no discrepancy. We all have that. We can see it. It's right there, okay? You can't do that with Forex because everybody has their own Tom, Dick, and Harry spreads. And that's how it's not the gentleman's choice of markets. It was great when it was wild and woolly, and that's why I left futures to go over there because there was a lot of excitement, and I knew I could do very well in short little time frames and capture big movements. But now we've had a little bit different dynamic, so I want to go back to what I trusted and where I started in 1992, which is the commodity and futures markets. And they're going to be much more precise and more refined. You're not going to see a whole lot of tomfoolery in it. It's very, very specific. You can make a career out of these one individual markets and not have to look at anything else. You ain't got to figure out which Forex pair to worry about. No interest rate differentials to worry about. It's just, are we bullish or are we bearish? And where are we looking to go? Real simple. You can have a very short work life too, with 1 hour a day and you're done. And it's consistent. But when we look at PD arrays, and I was using the institutional order flow as an example, my point when saying all that was, when we're bullish, every down close candle should support price. Every time it touches it or goes into it, it should start repelling and setting price higher. And price should spool higher after doing so. If we have met a range extreme, or we traded to buy side liquidity that would constitute a potential reversal, while order flow has been bullish and we've maybe capitalized on that, now if we have seen a run on buy side and then it broke market structure and then rallied up and gave you a 2022 short entry, what do you think you would be expecting as the price is dropping down? Every one of those down close candles that supported price going up, you want to see price eat through that quickly with no hesitation. You want to see those down close candles in the hands of anyone else. They're going to think that that's a bullish order block because they think every down close candle is an order block, and it's not. It's not. There's a narrative at work that you have to know what that is to make the order block be what you expect it to be in terms of a catalyst to be an entry or a target. Hello. So every PD array has in its formation a application of wanting to see it fail for the purposes of giving you insight, then you can use it for a counter trade idea. It has an inverse nature to it. So when you see price like this and you finally, and what I just said, for some of you that are brand new, you don't know what I'm talking about and you don't really appreciate what I just said. But for students that have been with me for a long time, they just had a light bulb moment because now all of a sudden they're like, wow, I don't have to worry about my model in the PD array like the breaker. If it fails, I can have an inversion and trade off of that. If I use a mitigation block and it fails, okay, when it trades back to it again, I can trade it inverse and capitalize even with half the leverage and get back what I lost and still find a profit. So there's no reason for you to fear or try to avoid losing because you're going to lose. You're going to have a losing trade. You will absolutely have a losing trade and probably have a series of them, especially when you're brand new. But there's nothing to fear. There's no reason for you to fear that because your ability to judge and pick the very specific entry points and measure the risk that's appropriate for you from your entry to where your risk is, that's a skill set that's going to take you a while to figure that out. I have rules that help you do that, but you still, like I talked about the Twitter space yesterday on my Twitter feed, I talked about where motivation becomes impulse. You have all these good intentions of going in and looking at the chart and maybe doing something that is highly organized and specific and disciplined, but when you get there and you're the excitement of maybe potentially missing it and then second guessing yourself and you think, well, what if my model isn't there, but I do see it moving up here and I think it's really going to go up above that old high or below that old low, and you completely abandon the model and you trade recklessly and impulsively. You won't do those things when you start seeing that this dynamic that is in price action. These things repeat all the time. They repeat all the time. And when your model fails you based on whatever PD array that is that you're using as an instrument for entry, whenever that fails, just know that there's one of my students that were looking for that very PD array to fail because their model is returning back to it and then using that. Never looked at it like that way, have you? But that's exactly what some of my students do. They're not they're not breaking the models. They're not trading outside of what I taught. They're just using it in a model that fits their expectations on price at that given time. And it may not be an inversion fair value gap that you use as your model, but it gives you the flexibility to say, okay, I use fair value gaps to enter. But if I get it wrong, that means it's probably indicating that I'm really offside. So if it comes back up and trades back up into this level here, it might offer some measure of resistance. So therefore, we could see an opportunity for it to trade. And where would it trade to? Here's a daily low right there. What could you use as a partial before you get to that? Half of this range, which is what? Right here, which would be right below Friday's low. The opening of that candle and the consequent encroachment of the wick. Do you have to take a partial every single one of them? No. Which one would make sense for you based on how much you're leveraging, where you got in at, where the entry was? Because it could trade up to here and break extremely hard. And then the only first fair value gap it gives you would be down in here that you would feel comfortable taking. And there's a lot of things that you have to weigh out. And unfortunately, there isn't this always easy 1, 2, 3 criteria or recipe where it always does the same thing at the same manner, the same range in pips of risk, the same pips in terms of the profit, and every profit partial should be only this many pips away from where you got it. You can't do it that way and be consistently uniform. I wish it was like that, and I was trying very hard as a young man to make trading like that, and I've come to the conclusion it's not necessary. That's something that will evade you. That's perfection, and perfection's not necessary in profitable trading. That's an epiphany that once you get that, you don't have to be perfect to be profitable and to be content in that profitability, not thinking I didn't get enough, which is why I always preach what? Be content with enough. Do you have more money today than you had at the start of the day? If you do, stop. Go home in profit. Get used to feeling that. Who cares if it's only $50? Who cares if you just you covered the cost and commissions and you're not in a net loss for the day? We can go home and feel what that feels like and grow comfortable at saying, you know what? I didn't lose money today. Your first goal is to stay as a break-even trader because most people go right out the gate, go straight down and lose. You don't want to do that. You want to be able to maintain that watermark of where you opened up your equity, that balance. You want to stay real close to that until you figure out who you are and what you're trying to trade with. You're going to discover a whole lot about yourself when you start trading with real money. When there's real risk, you're going to decide whether or not you can trade with that model, with that time frame, with that measure of risk, that number of handles or pips that you're trying to use as a stop loss. It might not be feasible. You might need to trade with a larger stop loss because your precision isn't there yet. And that's not a knock against you. That's not saying that you can't be more precise with smaller stop losses eventually. But so many of my students try so quickly to try to rush to these really small little tiny stop losses, like that somehow makes you superior to someone else. It's not, because the chances of you getting stopped out exponentially increase. It demands precision that you may not have yet. Whereas someone that's brand new and they offer themselves a 15 handle stop loss, that sounds like a lot. It is if you're trading with 5 or 15 contracts on a mini for S&P or NASDAQ. That is a lot. But you're not going to feel that way if you're trading with one micro lot. It's not going to be that much. And you have to learn how to manage yourself. You have to learn how to hold on to these trades and not freak out and be in a rush to get your stop to break even or profitable. That's an entirely different lesson you have to learn too. That can't be taught in a book. I can't teach you a lesson that makes you feel comfortable doing it. You have to follow the rules I've provided and then do it. And you'll discover, okay, I need more time doing this with a lot less leverage. And which is why I tell you go down with the micro. $5 per handle for the E-mini S&P and $2 per handle on the NASDAQ. That's not a lot of money, but you can still make money doing that and learning how to get good at it. So many of you get these funded accounts, like my son. He can get these funded accounts. He's made money with it, and he ran in there and tried to do a $150,000 account and dusted it quickly because he went back to doing big contracts again because he thought, well, all I got to do is replicate what I did there with more contracts, and he found out he can't do it. The fluctuations of the money scares him. So if he's scared of the money, is he going to think about the trade, hold it correctly? No. 2 ticks or 3 ticks of movement against him, it scares him out of the trade. He closes it in a loss, and then it runs in where he's thinking it's going to go. And he does that multiple times, and eventually hits the maximum loss, and then that 150 count is gone. He did that with 2 of them this week. You're not obligated to know that. But I'm telling you, just because he's my son, he's doing the same things that some of you probably are doing right now because you're impulsively trying to do things that you're not really ready to do with an amount of risk that's too high for you. You have to graduate into that. I don't know why I even brought that all that up, but just know that the stop losses, I would like to keep the stop loss tight here at just above consequent encroachment if it was a trade up to that level there. And if I got stopped out, it's okay because I'm following the rules of what I've outlined here. But because we've overlapped it and we went from the highest point, the consequent encroachment of the fair value gap, and the low, and went beyond it, and we closed below it here, if we open below this low and trade back up to that level there, I would expect it to act as resistance. And it could only, in my opinion, be high probability if it stayed below consequent encroachment or just 1 tick above it. And I would not want to see it trade to the high end of it and still act as an inversion fair value gap to offer lower prices. That's how I'm framing it, so you know what I'm looking at, why I'm even factoring any interest around these specific levels. So now, because if we have something that forms and I point to something, whether it be hindsight, after the fact, throughout the week, you know that I've outlined the very things here. And if it doesn't work, it's great. You'll get to see what it's like to be here before the market opens up on a Sunday where everything is completely random. You don't know where that opening price is going to be.